All right, ladies and gentlemen, shall we get started? Let's take a look at the results of the poll. Then we'll see what is everyone feeling today. Looking into the first question here, feel free to scan the QR code and participate in this, whereby we're asking you just a very simple one. Where is everyone actually heading to end of this year, right? Are you heading to anywhere for holidays? Anywhere interesting with your friends and family? So far, so good. Mostly Asia. Give it a few more seconds to getting some answers. And it's interesting, actually, a lot of people just want to be in the Asia space, right? Especially to stay in Singapore. Truth be told, I always like to travel. So thank you for your participation. We'll head on to the next question. All right, so what is the biggest question now here is challenges when it comes to investing. A lot of times, clients don't really know what's the best place to enter, the best time. I guess right now we are more towards the understanding the markets, uncertainty, volatility, and I guess this is something that most people will face, right? Trying to understand where the market is at. Very good. And we move on to the last question. Okay, so this is an interesting one, right? So what is the proportion of active funds in the US that outperforms the S&P 500? For now, it seems like equal weightage among most of the answers. But just to give you a quick summary, actually, the answers is nearing towards the 90%. And to our surprises, actually, a lot of funds at active management don't really outperform the S&P market. And this is something interesting where we'll all talk about it afterwards. Okay, so very happy. And thank you so much for joining us today. We will get started. And everyone, welcome to today's session once again. My name is Kenny, and I am a wealth advisor from the Syfe's advisory team. I'll be your host for today, and we thank you for joining us for this evening. So today's session is really just all about enhancements, right? How do we stay relevant? How do we adapt to changes in the markets? And how do we boost your long-term returns in a sustainable manner? After all, change is the only constant, right? And that's the reason why today we'll talk exactly how we can revamp and optimize our portfolios here in Syfe. And we're also very proud to say we have a very strong lineup here with us today to discuss exactly how to do that. So right here in the screen, we'll talk about today's agenda. We're happy to have Ritesh from Syfe to give a quick market update and review on Syfe's portfolio performances. And we have Aman next from Syfe, which will then speak about the latest updates to our portfolios and the benefits that will come with it. Next, we have Andrew from Morningstar to discuss about MOAT and how it can really make a difference in constructing a portfolio. And finally, we have Jonathan from DWS X-Tracker, and he addressed the concentration risk and how to mitigate it. Ritesh will be the one closing it off together with the value propositions and Q&A. So without further ado, let me introduce our speakers for tonight. First off, we have Ritesh, who is our Managing Director, Head of Investment and Advisory here in Syfe. It is mostly responsible for the overall development and evolution of Syfe's investment product suite, of course, the region. And it's also to enhancing it to cater to the mass evolving needs of the modern investor. And I'm pretty sure most of us have seen it before. And he's been a very regular contributor on our webinars and seminars. So thanks for joining in, Ritesh. Next up, we have Aman, who is also our Director of Portfolio Construction and Quantitative Research here in Syfe. He specializes more on developing and implementing complex strategies and models to construct portfolios that helps clients to also mitigate risk, right? So I've known him for some time now, and I must say he's really a specialist in this field, right? Thank you, Aman. Next up, we have Andrew. Right, he's a director of equity research, especially in the index strategies for Morningstar Research Services. He has also been with Morningstar for over 11 years right now. And he's actually started off as an equity research analyst. He's really made a name for himself here in this industry. And I'm pretty sure everyone here will be able to benefit from his experiences. And next one, we would have Jonathan. So he is a coverage specialist with DWS X-Tracker. covering asset management clients from all over Southeast Asia on the equities, ETFs, passive mandate solutions, which is also what Syfe works with a lot too, right? So I'm sure having him here with us today will be a good value add to everyone. So for our viewers tonight, do look forward to more fresh ideas and solutions catered to you as we grow as a modern digital investment platform. So with that said, I would love to invite myself to give us a quick introduction about Syfe and what we aim to do for our clients, especially for those who are joining us for the first time this evening. And then, what is Syfe all about? Right, Syfe is a digital investment platform whereby we aim to empower our clients to build their wealth for a better future. So we're also headquartered here in Singapore and MAS licensed too. Okay, so at the end of the day, we are also a digital mobile first approach. So moving on to the next slide, this is where we manage our portfolios, the managed portfolios, cash management solutions, as well as our brokerage platform, whereby it's all very accessible within the app itself, right? This allows our clients to invest in a very holistic as well as a seamless manner. So our advisory team here, like myself, will also add on an additional layer of guidance and support on top of it, okay? So next slide. We are trusted by over 100,000 clients here in Singapore. And that's also because we value, or rather we provide value in terms of security, expertise, and transparency to all clients. So at the end of the day, we have a quick snapshot of our journey so far. On the next slide, we are launched on July 2019. And we have also went through many significant milestones in a short span of time. Next slide, please. So from here, you can see a snapshot of what's happening. And of course, back in 2023, that's where we really introduced our Income Plus portfolios powered by PIMCO and further developed our cash management solutions with a Cash Plus guaranteed. And till now, it is still very popular amongst our clients this day, right? So I would like to take this opportunity to thank everyone here that made Syfe into who we are today. And we will continue to do our best to provide the best experience and services to our clients. So without further ado, I'm very excited to welcome our first speaker, Ritesh. He will give us a quick market update, performance review on our core portfolios. Ritesh, please.
Hey, Kenny. Thanks for the introductions and very excited to be here today and talk about the Syfe core portfolios, our philosophy, and also start off with like a market outlook, right? Like, I think a lot of investors have been invested in our core portfolios for a fairly long period of time. And again, this is an important juncture that we are with, the turn of events in terms of how the interest rate cycle kind of evolves in the US and more globally as well. So obviously, let's start. If you move on to the next slide, let's start with the Fed's big move in September, right? So they cut interest rates by 50 basis points, and that kind of like brings the key interest rates down to the range of 4.75 to 5%. And this is significant because like we have been in the rate hiking path for almost like 2 years. This was the fastest rate hiking cycle that we have seen. And obviously it impacted markets quite negatively through 2022 and 2023 to a certain extent. And then like, over the last 1 year, we have seen the equity markets and the broader markets starting to become much more resilient. And I think this is an important juncture. It is significant because it kind of signals a shift in Fed's focus, right? The inflation numbers are now nearing its 2% target, and now the Fed's focus is now more geared towards prioritizing economic growth and stabilizing the labor market, which is starting to show some signs of weakness. I mean, even though the last print actually was better than expected. And this is a proactive cut, right? And it is critical as it lowers like key borrowing costs. It stimulates the consumer spending. And as investors, it kind of sets the stage for a shifting market dynamic, and it creates new opportunities as well. Now, historically, this leads to a more favorable environment for both equities and bonds, and especially in case if the Fed is able to engineer what is called as a soft landing and avoid a recession. So going on to the next slide, what have we learned from the past rate cutting cycles, right? If you look back, all the way to 1981, you can see that the Fed has actually gone through 9 distinct rate cutting cycles, right? And each lasting on average around 16 months. And the average cuts have been north of 4%, right? Like, once you start cutting, the number of rate cuts are such that, you end up with a total of, more than 4% rate cuts. Now, that might not be the same in this current juncture, but we are clearly in that rate cutting path as we move forward. And the important thing for us to note is it's the history of the Fed rate cutting cycle. It highlights kind of their dedication to economic stability. And it also tells us that the Fed is kind of like adaptable. It is data-driven in its approach. And the past cycles kind of demonstrate Fed's readiness to kind of like act decisively and especially, try to avoid crisis situations. And the key takeaway is that the Fed is able to, if the Fed is able to achieve a soft landing and avoid this prolonged, recession environment, it can drive a favorable environment for risk assets as well. And for investors, this could be a beginning of, another sustained period of growth, especially if you position your portfolios wisely. So moving on to the next slide, obviously, this brings to the question as to how asset classes will perform in different rate cutting cycles. On the equity side, if you look at the performance, it has been mixed, right? Like, depending on whether it is an insurance kind of a cycle, meaning that there is no recession, or if it is actually a recessionary cycle. And if you look at the data, what you can see is equities typically outperform and generate more than double-digit return, 16+%, if a recession is avoided. However, if recession actually hits, stocks often underperform, and the average negative return can be more than 20%, right? So that can be a bit scary, from a perspective of the different outcomes that you can expect depending on whether there is a recession or not. Bonds, on the other side, you can see tend to outperform both in recessionary environments as well as, in non-recessionary environments, making them more like an attractive safe haven of sorts. And what I think that tells us is we need to be, treading our path a little bit more carefully as we move forward, especially, I think, with the backdrop of US elections, the evolving kind of like these Middle East geopolitics, etc. We should be prepared for a more volatile period ahead. And this is where, like, a smart portfolio construction kind of comes into play. It is important that we diversify across asset classes, especially, balancing your equity risk with safer fixed income and, other asset classes. And this is what can help you protect against downside risks while still capitalizing on the upside potentials of the market as the rate cuts kind of unfold. So moving on to the next slide, there is also, I think, a rotation at play. There is this case that now with the Fed actually cutting rates, we are generally seeing a broadening out of the equity rally, right? Like, historically, after the first rate cut, value stocks tend to outperform growth stocks over the next 6 months. And this happens because investors seek these undervalued opportunities and in companies that can benefit from these lower borrowing costs, right? Similarly, small caps, mid caps, etc., they tend to catch up and even outperform large caps over a more longer 12-month and beyond horizon. And these smaller companies, again, tend to benefit more from these lower interest rates, right? Like, which can reduce their cost of capital and can open up more growth opportunities. So clearly, I think, like, this is an important juncture where, we have seen the domination of large caps and growth stocks over the course of the last few years. And we are at that, inflection point where potentially, with rate cuts coming into play, there is this broadening out of the equity rally that can happen. And why is it important? Like, if you go on to the next slide, we talk about concentration risks, right? Like, if you look at the Magnificent Seven stocks, the concentration of these Magnificent Seven stocks in the broader indices such as S&P 500 is at all-time high. They represent more than 30% exposure to these indices, and so far, obviously, they have dominated returns as well when it comes to outperformance against these more broader indices and all. So the AI wave has definitely helped these companies outperform heavily over the last couple of years, I would say. And if you look at this chart, you can see that the dominance is kind of evaporating to a certain extent. As the collective performance of the Magnificent Seven, if you just exclude NVIDIA from that, right, like, which obviously has been a clear beneficiary of this whole AI wave, it now, if you just remove that, the overall returns of Magnificent Seven now trails the broader market on a year-to-date basis. And why should we care about it? We should care about it because if your portfolio is overtly concentrated in just a few of these stocks, you may be exposed to the success or failures of these specific companies, right? And with rate cuts, we do expect, some rotation to happen into sectors that have been less loved previously, right? And have been kind of left behind, and opens up a whole new range of possibilities there. So if you go on to the next slide, if you look ahead as well, there are more fundamental reasons as well for you to look at this and think through how the markets are going to play out. One of the important aspects is the earnings growth of the mega cap tech stocks was kind of like justifying why they were trading, or they're still trading at these premium valuations. But as we move forward, you can clearly see that the advantage that the mega cap tech stocks had or continue to have in terms of the earnings growth is starting to slow down, right? The earnings growth of small cap and mid cap companies are now showing stronger growth potential, and to the extent that now the gap is narrowing down. And with the rate cuts, this can lead to these sectoral shifts, and this is where we see the opportunity. And that's why I think it is important to look beyond the Magnificent Seven. If you can look at some of the more quality small cap and mid cap stocks that can benefit from these cyclical rotations, I think that is where the future kind of can unfold. And the bottom line is the dominance of the Magnificent Seven might not last forever, and that's why the diversification aspect is pretty crucial for investors. If we move on to the next slides, I think that's where I think I will quickly pivot onto the Syfe core portfolios, right? The market outlook in mind. It is important that I kind of highlight what our core portfolios are designed for. We have designed these as our flagship offerings. They are meant for your long-term investment needs and to solve for your essential financial goals. These are purpose-built, right? And they're globally diversified. We use low-cost index ETFs. Whether you're looking for a more aggressive growth, or you are looking for more balanced options, our core portfolios are really designed to meet these essential financial goals and for each level of risk that you're exposed to. If you move on to the next slide, let's quickly understand how we thought about designing our core portfolios, right? That is fundamentally to address some of the key challenges that we see with more active forms of investing. Typically, these more active forms of investing comes with things like underperformance, right? You pay high active management fee, but the actual performance of most of these active managers tend to lag the broader benchmark. And I think we did this survey previously, and I think the vote was pretty split. I think there was no one side in terms of how people are thinking about active managers and the outperformance. But the reality is actually more than 80% or even 90% of active managers, they fail to consistently beat the market. They underperform broader indices. And this is the problem with emotions and other aspects coming into play. And this is kind of also exaggerated by the high management fees that you pay into these strategies, and these really eat into your returns over the long term. So that's why at Syfe, we have recognized these issues. We have built these core portfolios to avoid these pitfalls, and we use a very disciplined investment process that optimizes your return over the long term without having these emotional biases and high costs with active management. So if you move on to the next slide, basically our core portfolios are grounded in 3 essential principles, right? We have built them for global diversification. We have implemented them using low-cost ETFs, and we expertly manage them ourselves so that you don't need to think about, what, underlying instruments should I buy, in what proportions I should buy, how do I optimize them, how do I time the market? Again, these things are all, taken care of by us. Basically, if you think about diversification, it spreads your risks across regions, sectors, asset classes, and that thereby kind of protecting your investments from, very specific localized market downturns. Low-cost ETFs, very, very important, because essentially what you're trying to do is, minimize your cost of investing, and, you're making your money work harder and lowering your overall cost, right? Like, so most efficient way for you to deploying your capital and getting that market exposure. And on top of that, we layer our expert management, right? Like, we focus on maintaining a balanced and diversified approach that aligns with your goals. And we focus on maximizing your long-term returns through this disciplined and data-driven approach. And again, we partner with some of, the best asset managers, right? Like, today we have DWS, we have Morningstar with us, and, with the others as well, like BlackRock, VanEck, Dimensional. We partner with these, asset managers, which, focus on broad-based index exposures at very, very low cost. And again, from a diversification perspective, you can see that the portfolio is diversified across multiple companies. We have exposure to more than 1,500 stocks in our portfolio. So, you don't need to worry about a single particular, underlier driving a huge deviation in terms of returns, et cetera, and all as well. So let's move on to the next slide, where I quickly want to cover how is our investment approach, right? And the investment approach basically follows a very passive long-term investment strategy. And instead of trying to beat the market, our focus is really to generate a superior risk-adjusted return over time, right? And our investment process is kind of like built on modern portfolio theory, emphasizing, your diversification, your risk management, and the collection of the core portfolios. We are trying to maximize return at each level of target risk. And that's where I think, like, it differentiates from that whole active management of sorts. Instead of using, trying to time the market and trying to, think through which parts of the market will move and have a more beneficial situation in the near term, we really focus on incorporating smart beta factors. And these are, things that I think, like, Aman will later on allude to in terms of how we incorporate these factors. But the, main aspect of these factors is these factors tend to enhance your long-term returns. These have been grounded by research. They help reduce volatility, and they also improve from a diversification standpoint. Some of the key factors, that we have right now include value, quality, size, and even emerging market exposure. And these are the factors that help us, driving these long-term enhanced returns. If you move on to the next slide, this slide really captures, how traditional asset allocation work, right? Like, we had these 3 points in terms of our investment process. The first, point was about portfolio allocation. Now, typically, when you think about portfolio allocation in a moderate risk portfolio, most of the like wealth managers will talk to you and tell you that a 60-40 portfolio is well diversified. So you take that and you are okay, and you have a moderate risk. The reality is, the risk allocation is not really 60-40. Take an example where, like, if you've put $100 to work, and if the market corrects and your $100 becomes $90, the reality is, even though stocks are 60% of your portfolio, it contributes more than, $9 out of that $10 loss. So your risk contribution is not, 60-40. It is more like 90-10 or even more. And this is where, in our process, we don't blindly just employ an asset allocation approach of 60-40, and then over time, if the portfolio drifts from this allocation, you bring it back to 60-40, right? Instead of that, what we use is called as asset class risk budgeting. We use each asset class's actual risk contribution to the portfolio, and then we optimize to drive, long-term better risk-adjusted returns. That brings us to the next, part, which is the factor investing, right? Like, we already talked about smart beta or systematic factor investing. Now, these are conceptualized to enhance passive strategies, right? Like, instead of just tracking the market, which you can obviously do with just passive investments, smart beta actually, captures some of the risk premia. And when I say risk premia, it is basically these factors which more of the active managers tend to, play out, that they have a fundamental, foresight in terms of what they and they have an investment process to outperform the market. The reality is there are these fundamental factors that drive long-term returns. And these factors are, value, size, quality. And we approach, these factors from a very rule-based approach, right? So instead of trying to time the market, we incorporate these factors and have a strategic long-term allocation to these factors, which help us, generate that, long-term outperformance and all as well. So if we move on to the next slide, that kind of like captures the 4 different core portfolios that we have built. They're really meant to purpose built for your different financial needs. So if you're someone who's really aggressive and wants to maximize your returns in the market, then obviously you can go with the equity 100 portfolio because it gives you 100% exposure to the equity markets. And then if you are someone who wants to, still have that equity, overlay or a more dominant, equity, allocation, but you want to have a little bit of bond overlay and all as well, then you have the growth portfolio, which allocates a small amount to bonds as well as commodities, that is gold. And similarly, for the more balanced and conservative investors, we have the respective portfolios there too. And each portfolio, again, is designed to align with your unique financial objective, right? Like, it's not like a one-size-fits-all kind of an approach, right? We're really tailoring these portfolios to align with your specific goals, your time horizon, your risk appetite. And that's where I think, like, each one is making sure that, like, you're trying to solve your core needs without kind of compromising on, the performance. So that brings us to the next point, that, like, why portfolio construction matters, and like why you should, look at Syfe as one of the places where you can build your portfolios much more, confidently. So if you go on to the next slide, essentially, most of us, like, would like to obviously beat the market, but the reality is, like, beating the market does not mean, you time the market well and then you will do well. Or, if you are very good at security selection, that's how you will drive long-term outperformance. The reality is actually 90% or more than 94, this talks about 94% of long-term, performance actually comes from the asset allocation process. And we talked about risk-based asset allocation versus traditional asset allocation. And in terms of how we manage, our portfolios, the, whole focus is to make sure you get the broad-based, equity exposure, the index exposures, etc. And with the overlay of these smart beta factors, we are driving these long-term outperformances for you. And that is why I think if you go into the next slide, the proof is basically in the numbers, right? Like, and as you can see, our portfolios have consistently outperformed their benchmarks. This year, particularly, our equity 100 portfolio, have been dominant. And if you stretch it over longer duration and all as well, you can see that all of our portfolios tend to outperform the market, and they are built in a way such that they're driving outperformance by not taking excessive risks, but they're really driving outperformance by having that consistent long-term overlay in terms of how we are approaching our investment process. So really, I think the idea is for you to invest into a portfolio which is steady, which is reliable, and it is built for the long term, and it is tailored to your different investment needs. So that's where I would, quickly at this point, hand it over to Aman, because there are obviously some big changes that we have done to our core portfolios. And this major revamp is something that will enhance your return potential even, better going forward. So over to you, Aman.
Thank you, Ritesh, Kenny, and everyone joining us this evening. It's a true pleasure to speak with you, and I'm excited to dive into the details of our core portfolio's revamp. This is the biggest upgrade we've ever done. A lot of time and effort has gone into optimizing each detail and collaborating with our partners. Let's start with the key benefits. On the next slide, from our equity component perspective, we've enhanced the return potential, placing a greater emphasis on size, value, and the quality factors, whilst reducing our exposure to the growth factor to maintain a balanced portfolio which will deliver stronger risk-adjusted returns over the long term. We've optimized bond allocations, ensuring there is broad bond market exposure and introducing corporate bonds, both investment grade and a measured allocation towards high yield, in line with our benchmark, always mindful of risk management. This will increase yield whilst preserving capital. And across both equities and bonds, we've improved tax efficiency with a significant strategic shift to UCITS where appropriate, saving on dividend withholding taxes and boosting performance by up to 0.7% on an individual ETF basis per year. On the next slide, we'll deep dive into our factors. Factors are characteristics that help explain differences in stock returns. They're the building blocks of our investment strategy. For those new to factors, I'd encourage you to visit our website where we have a full explanation of what they are and how we use them. Tonight, I'll focus on the key factor changes we've made in this revamp. We've enhanced our value exposure. That's companies that are undervalued relative to their fundamentals, such as earnings or book value. They're attractively priced. We've also increased our exposure to the quality factor, also known as high profitability. These are companies with strong fundamentals, stable earnings, balance sheet. We've now added more size exposure, introducing small and mid-cap stocks to our portfolio. At the same time, we've reduced our exposure to the growth factor. This has helped to manage concentration risk and keep the portfolio more balanced. Now, on the next slide, let's have a look at why we've done this. This slide illustrates over the long term how size, value, and quality have all historically delivered excess returns over the market. This is backed by extensive academic research, most notably Farmer and French, and their 3-factor model, which was later extended to 5 factors. By tilting the portfolios towards these factors, we aim to position our investors for stronger risk-adjusted returns over time. So how did we implement these exposures? On the next slide, we welcome MOAT to the core portfolio family. Next slide, please. The VanEck Morningstar Wide Moat ETF uses the Morningstar Wide Moat Index and captures both quality with a value overlay. There is a focus on US companies that possess sustainable competitive advantages, or MOATs. The index further targets those companies trading at attractive prices relative to Morningstar's estimate of fair value. These are then incorporated under an equal weight methodology and are backed by the Morningstar research team of over 100 analysts. Later this evening, Andrew Lane from Morningstar will take us through this index in more detail. We believe that the MOAT strategy is well positioned as mega cap tech struggle through changing market dynamics and high valuations. On the next slide, we have XDEW, a new friend who feels familiar. We've maintained our exposure to size and value and the S&P 500 equal weight index. This is in UCITS form, enhancing the tax efficiency of the dividend yield. The S&P 500 equal weight index invests in the same 500 largest companies in the US as the S&P 500, but it is weighted equally, regardless of market capitalization. On the right-hand side, we can see what this means visually for 4 example stocks. In the lighter blue, you can see the weights that these stocks have in the S&P 500 market cap weighted. As I'm sure you know by now, the S&P 500 has incredible concentration risk right now. The top 10 holdings account for over 35% of the whole index. Unsurprisingly, the equal weight index doesn't suffer from this problem. The top 10 holdings are a mere 2% of the index. Later this evening, Jonathan will be taking us through the equal weight index. Now, on the next slide, a discussion on factors would not be complete without dimensional. The very DNA of factor investing sits within their company through Eugene Farmer and Kenneth French, who we mentioned earlier. Their factor model research was groundbreaking in quantitative finance. We've selected the US Targeted Value ETF, which invests in over 1,400 small and mid-cap companies, specifically targeting value and quality. For those who are more visually minded, the cross-section on the right may help you understand the emphasis on size, value, and profitability or quality. You could picture all the US stocks as cubes on a ginormous Rubik's Cube, where each axis is size, quality, and value. What Dimensional have done with this ETF is slice through one of the corners, taking the smallest, most attractively priced, and higher profitability stocks and placed a greater emphasis on the investments in those. We believe this is a robust and efficient exposure to these factors that complements our broader portfolio. On a personal note, I can talk firsthand about Dimensional's unparalleled focus on efficiency, from portfolio construction to trading performance and costs, having previously provided them with some of the trading algorithms they use globally. Now, on the next slide, that brings us to the overall equity allocation changes, and I'll focus on the pieces we haven't yet discussed. We've boosted our allocation to global markets to better align with our benchmark, helping to reduce tracking errors and ensure the portfolio closely mirrors the broader market movements. We fine-tuned our exposure to emerging markets to address price drifts that can occur due to market fluctuations. We've already covered the quality, value, size, and growth factor exposures and the usage switch that involved. Finally, we've removed our sector-specific allocations to better align with the broader market. This will reduce the likelihood of significant performance deviations away from the market. We've talked a lot about concentration risk. So on the next slide, let's explore this with a visual. This shows the concentration and the allocation of the top 10 holdings of each of the S&P 500, our benchmark, the MSCI All Country World Index, and our new revamped Equity 100 portfolio. As you can see, the S&P 500 suffers from incredible concentration risk. The MSCI All Country World, slightly less so, but with our revamped Equity 100 portfolio, we've done a lot of work to diversify this risk and ensure that we have broader diversification across the global markets. Now, turning to performance, and I imagine that's why many of you are here tonight. I'm delighted to announce this year our flagship Core Equity 100 portfolio has delivered 15.8% so far, eclipsing not only our benchmark, but all our peers. But we are always striving to do better. This revamp positions us further for excess returns over the long term, particularly when we look at the 8-year annualized return from our simulation framework. This revamped Core Equity 100 portfolio outperforms not only our existing portfolio, but our benchmark over these measures. Now let's switch gears into fixed income. On the next slide, you'll see the key changes we've made across our bond allocations. We've shifted our focus from US Treasuries to align more closely with broad bond market exposure in line with our benchmarks. To achieve this, we've carefully selected 2 iShares UCITS ETFs, which cover the broad global and US bond markets. To further enhance your portfolio's income potential, we've introduced high-quality credit in the form of corporate bonds, both investment grade and a measured high-yield allocation, again, in line with our benchmark, mindful of risk management. This has increased total yield whilst decreasing duration, and we can see this in more detail on the next slide. The yield has increased by 0.8% per year on the fixed income portion of all of our core portfolios. The duration has also now reduced to 7 years, which is much closer to our benchmark. This will reduce significant deviations in performance in the future, providing a smoother experience to you, our clients. Now let's take a closer look at the overall fixed income allocations on the next slide. Now, as we review the full allocation changes, you can just take a look at the core growth column. The fixed income allocations are consistent across these 3 portfolios. As you can see and highlighted earlier, we've increased our exposure to global bonds in the form of UCITS ETFs with further tax efficiency. This will help reduce tracking error versus our benchmark. You can see the subsequent reduction in US Treasuries and also our allocations to both investment grade and high yield corporate bonds. These adjustments enhance income potential while maintaining a focus on risk management. Finally, let's see the benefits of the UCITS switches. On the next slide, you'll see we've made significant increases in our UCITS allocations. We've achieved an allocation of over 40% across each and every core portfolio that our clients hold. This is after having conducted a thorough analysis of the various options, considering factors such as liquidity, cost effectiveness, and the availability of specific exposures. This strategic move could translate to estimated performance improvements of up to 0.7% per year on an individual ETF basis. Now it brings me great pleasure to introduce Andrew Lane from Morningstar, who will talk us through the Morningstar Wide Moat Index in more detail. Andrew, over to you.
Fantastic. Thank you, Aman, and thanks everyone for joining us today. So let's move to the next slide. And I'm very excited to be here today to talk to you about the Morningstar Wide Moat Focus Index, which is, of course, now available on the Syfe platform. So I'll start with the overarching concept, and that's the economic moat approach, right? And so Warren Buffett was the first to use the phrase economic moat. He said, in business, I look for economic castles protected by unbreachable moats. And what that really means to us is companies with durable competitive advantages, where they enjoy some sort of a unique characteristic that helps protect their business from competition. Let's move forward to the next slide, please. And so the research that provides stock selection for this index is provided by the Morningstar Equity Research Team. And so as we'll talk about in a little bit, there are really just two data points that determine stock selection. It's our economic moat rating, but then also our valuation, right? We don't want to overpay for a great business. And so while that may seem very straightforward, right, just two data points determining stock selection, there's a great deal of comprehensive fundamental research that goes on below the surface to determine those economic moat ratings and that valuation. As Aman mentioned earlier, we have over 100 equity analysts at Morningstar doing that research, and we cover about 1,600 companies around the globe. I think more importantly than those numbers, however, is the ratio between those numbers. Our analysts only cover about 16 stocks apiece on average, and that focus, having very few companies to cover, allows us to have an even better understanding for what really drives cash flows for those businesses, so we can understand if they have a competitive advantage or what our valuation should be for those companies. Let's move forward to the next slide, please. So the first of those two data points I mentioned is the economic moat rating. And to go a layer deeper into that methodology, we look for at least one of five what we'd call economic moat sources. You can see those at the top of the slide along the x-axis. These are the forms of competitive advantage that a company might have. I won't walk through all of them, but just a couple quick examples. The most common of these five moat sources is intangible assets. That's usually brand equity that provides pricing power, perhaps patents for a pharmaceutical or biotech company. And again, that provides pricing power, allowing for high returns on capital and a durable competitive advantage. The least common of these five moat sources is the network effect. And that's what we would call the virtuous cycle moat source, right? As the network grows, it becomes more valuable for new and existing users. So while the network effect might be the least common of these five moat sources, it tends to be the most potent in terms of all sorts of different metrics: returns on assets, return on invested capital, earnings growth, etc. And so while it's very rare, it's a very important moat source nonetheless. So again, we look for at least one of these five moat sources within a business model. Some have more than one, but all we need to see is at least one of these moat sources in order to say that a company may have a durable competitive advantage or an economic moat. Now let's move forward to the next slide, please. If the economic moat rating is the first of the two data points that determine stock selection, well, the second is our valuation. And as I said earlier, we don't want to overpay for a great business model, right? Just because a company has an economic moat doesn't mean it's always an attractive investment opportunity. And so valuation is very important as well. This is a 3-year stock chart for Workday, the ticker WDAY. Workday is a technology stock in the software industry. They are the top player in human capital management software. In other words, software used by human resources departments within large firms. It is the platform of choice for just over half of all Fortune 500 companies. So it's gained very wide adoption. But the focus of this slide is valuation. And here you can see that at work, right? So the orange line, it's mostly horizontal on this slide, is our analyst's fair value estimate for Workday. In other words, that's where we think the stock should be trading at any given point in time. The blue line, of course, is the actual stock price over time. So you can see that our fair value estimate was largely stable in 2021, 2022, and 2023. It changed a little bit in 2024, but by and large has not changed much over the last 3 years. I can't say the same for the stock price. The stock price has been fairly volatile over the last 3 years. And as you can see, when the stock was overpriced or overvalued relative to our fair value estimate, we either phase out or don't own it. When we see it as undervalued, we were able to phase it back into the portfolio. So this is an interesting stock because it was not held, phased into the portfolio, phased out of the portfolio, and now in 2024 actually phased back in once it pulled back a bit from a valuation perspective and was once again below our fair value estimate. And so this is what we're really trying to achieve, right? We want to own these competitively advantaged businesses, but be very, very disciplined when it comes to valuation. And let's move forward to the following slide, please. What that allows us to do, that focus on valuation, is maintain a portfolio that almost always trades at a pretty healthy discount to fair value. So if we take the fair value estimates of all the holdings and the stock price of all those holdings, what you see is that consistently, this is an index that trades below our take on what fair value should be. So over the last 10 years, it's traded at, on average, about a 14% discount to fair value. And again, that's what we're trying to achieve, right? These are all fantastic businesses with great business models, durable competitive advantages. But the focus on valuation allows us to consistently cycle in undervalued companies and then cycle out companies when they're fairly valued and overvalued. Let's move forward one more slide, please. And that brings us to the broader index construction methodology. So the selection set is very, very broad. It's about 97% of the US equity market. The first step, of course, is looking for those companies with the wide economic moat rating. And again, that's a very distinguishing characteristic, that wide moat. It's very rare across the broader investable universe. So it's important that we focus on just those companies with those very strong, durable competitive advantages or wide moats. Then, of course, the fair value estimate comes in, as you saw with the Workday example. We want to then screen for the most undervalued of those US wide moat stocks. And at the end of the day, what we're delivering is a portfolio of very strong, competitively advantaged companies with those economic moats that are trading at attractive valuations. Currently, this index has about 54 holdings in it, and those 54 holdings are across 2 sleeves of exactly 40 stocks each. Let's move forward one more slide, please. And that brings us to long-term performance. And this is something that, of course, we're very proud of at Morningstar. You can see at the top in the first table, when you look at total annual returns, this is a strategy that has outperformed the broader US equity market by nearly 300 basis points annually. And that's over a very, very long period of time. That's over more than 17 years. So large sample size of performance data there and very strong outperformance versus the broader market. The index comes with a little bit more risk than the broad market as measured by standard deviation, but investors have been far more than compensated for that risk based on the higher returns, and that's reflected in a higher Sharpe ratio than the broad market. Something that I think is very important about this index is that it's actually on average outperformed the market in a given quarter when the market has moved higher. That's reflected by the attractive upside capture of nearly 107 at the top right of the slide. But it's actually provided capital preservation as well when the market has moved lower in a given quarter. And that's reflected by a downside capture of about 87, right? So it's protected to the downside on average, but it's also been able to outperform in up markets. Now, of course, we don't outperform every single year, and you can see that at the bottom in the calendar year returns. But that attractive up capture and attractive down capture, I think you can see that in action with the sections or the years that I've highlighted here, right? So there were 3 years since 2007 where the broader US equity market posted a negative total return. That's 2008, 2018, and 2022. The wide mode focus index held up much better in each of those 3 years. But what I think is even more interesting is how it's performed in the 3 following rebound years for the broader market, 2009, 2019, and 2023, right? So after the down years in the prior years, we actually managed to outperform on the upside as well when the market recovered. And again, that's something that we're very proud of. I think when the market moves lower and you have downward volatility, we're able to find attractive valuations for these wide moat stocks, and that has helped us to outperform when the market recovers. One more slide, if you would please forward. I'll conclude my remarks by just commenting on where this index operates from a style perspective. On the right, you can see that it's been very consistently in that large blend style box. When you compare it to the broader market, maybe it has a touch more value exposure on average than the broad market, but by all means, I think it's safe to consider it a large blend strategy. Sometimes it leans a little bit more towards growth, sometimes a little bit more towards value, but again, clearly a large core or large blend strategy over time.
Thank you, Andrew, for running us through the index. Next, we hear from Jonathan of DWS X-Trackers, who will take us through the X-Trackers Equal Weight S&P 500 Index with more details on tax optimizations.
Thank you, Aman. So very excited to be part of this webinar with Syfe today to share with you some insights of the S&P 500 Equal Weight Index. But before we dive into the characteristics and investment merits of the S&P 500 Equal Weight Index, I thought it would be good to kind of share our insights as a UCITS ETF provider as to why UCITS ETF can actually be more tax efficient for non-US resident investors. If we could go on to the next slide, please. So one common question that I get from clients is, when I'm looking and evaluating ETFs, do I look at tracking error and do I just look at expense ratio? Well, these are criteria that are not wrong, but one criteria that often gets missed out is on the consideration of the domicile of the ETF. And this is especially so on US underlying when Irish domicile UCITS ETF can potentially be more tax efficient for non-US resident investors. And let me explain this with the example below that you see here, where we do a side-by-side comparison of the US domicile ETF, which is represented by the green box, against that of an Irish domicile UCITS ETF represented by the orange box. And when we think about dividend withholding tax, we need to look at this on 2 levels. The first layer being when the underlying securities pays dividend into the ETF, there could potentially be some dividend withholding tax there. And on the second layer, and that's where the ETF pays dividend to the end investors as well, there could potentially be some dividend withholding tax there as well. Let's have a look first in the case of a US domicile ETF. Now, on the first level, you would notice there is actually no dividend withholding tax on dividends paid out by the US underlying securities to the ETF. And this makes sense because, after all, they are both in the US domain. However, when you move into the second layer, there could be up to 30% withholding tax on dividends paid out by the ETF to non-US resident investors, depending on their tax residency status. And this could result in performance leakage, which could impact the long-term returns. And contrasting this against the Irish domicile UCITS ETF, now back to the first layer, you'll notice that when the US underlying pays dividends into the Irish domicile ETF, there is actually a reduced withholding tax impact of only just 15%. And this is largely due to the existing tax treaty between the Ireland and the US. And when you move down to the second layer, you'll notice when the Irish domicile UCITS ETF paying out dividends to non-US resident investors, there is currently no dividend withholding tax impact. So on the balance of things, it's very clear that for non-US resident investors, it would be better off to go with the Irish domicile UCITS ETF because the withholding tax exposure is kind of reduced by half, and the tax savings could be meaningfully compounded over time to generate additional returns for the end investors. And I believe this ties in very nicely with some of the examples that Aman shared earlier, as well as the recent rebalancing exercise that Syfe has done with its core portfolios. Now, with this out of the way, let's explore some of the investment merits of the S&P 500 Equal Weight Index. If we could move on to the next slide, please. Now, one of the key benefits of the S&P 500 Equal Weight Index is really the element of diversification, where an equal weight index can actually give you a broader sector representation. A common feedback that I hear from clients is that, with their S&P 500 index exposure, they are very heavily concentrated on the IT as well as the communication service sector. And they are rightfully so, because if you look at the sector weight table that we prepared over here, and something that I've already highlighted in red, you'll notice that IT and comm services accounts for almost 40% of the portfolio, and that's a heavy concentration risk over there. In contrast, for the S&P 500 Equal Weight Index, because of the equal weight methodology where they rebalance quarterly to ensure every constituents are equally weighted, you will see a more balanced sector representation. Clearly, on the onset, you'll see IT comes down to about 14%, communication services comes down to about 4%. One thing to also highlight is that because of this broader sector representation, the S&P 500 Equal Weight Index is actually more adaptive to sector rotations. If you think about it, if market sentiment turns a bit more defensive, right, you're probably going to see more flows into sectors such as healthcare and utilities, and these sectors could potentially perform better. And because of this broader sector representation, you'll notice that the Equal Weight Index will be able to capture this rotation place much better than the standard S&P 500 index. If we could move on to the next slide, please. So another aspect of diversification is that the S&P 500 Equal Weight Index also lowers the dependency of performance of just a few large stocks. And if you look at the weight of the top 10 constituents of the S&P 500 Weight Index, as what has already been pointed out by Ritesh and Arman, that accounts for almost 35% of the entire index weight, suggesting a very high concentration on mega caps. In contrast, the S&P 500 Equal Weight Index, the top 10 constituents only accounts for about 2.4%. Another very useful metric to look at will be the S&P 500 concentration measure, which is effectively calculated as the ratio of the index-weighted average total market capitalization divided by the unweighted average total market cap of the index constituents. So a higher ratio would suggest a higher concentration on mega caps. And based on the current data that we see over here, you can see that the US equity market concentration has reached the highest in the last 50 years, suggesting a high concentration risk issue. So using an S&P 500 Equal Weight Index will help to get around this issue by avoiding mega cap dominance within the index portfolio. So you must be thinking right now, okay, Jonathan, I get the diversification story, but how does the performance of Equal Weight Index actually stack up against the standard S&P 500 Weight Index? So if you go to the next slide, here we have the cumulative performance of the S&P 500 Equal Weight Index represented by the orange line against that of the standard S&P 500 index represented by the blue line. And very clearly, you can see that the Equal Weight Index has clearly outperformed that against the standard market cap index over a long period of time, dating all the way back to the 1970s. But where has the period of outperformance been? If we go to the next slide, what we have prepared over here is actually the rolling 12-month performance of an S&P 500 equal weight against that of the standard S&P 500 index. And in periods of positive performance, and that's where actually the equal weight index has actually outperformed against the standard market cap. And we've already highlighted that in green that you can see in the chart over here. And very clearly, the equal weight index does outperform in periods of economic recovery, such as the dot-com bubble in 2000, the GFC in 2008 and 2009, as well as the COVID-19 pandemic. And another interesting but yet not surprising point is that when we transpose this against the federal fund rate in the chart below, you can see that the performance actually coincides on the back of fund rate cuts, which tends to support a broad-based market recovery. And putting the current macro picture in perspective, we have already seen how the Fed has done a recent rate cut of 50 basis points in September, with potentially more rate cuts in the horizon. I think this could point towards a market backdrop that would support the broadening play, potentially benefiting the equal weight index a little bit more. If I could move on to the next slide, please. Now, just the last data point that I would like to share this evening will be the fundamental valuation, where we look at the trailing PE of the two indices. Here you can see the trailing PE chart of the S&P 500 index represented by the blue line and the equal weight index represented by the white line. And very clearly from this chart, you can see that the equal weight index is currently trading at a meaningful discount of 20% against the standard market cap index. And this is the widest discount that we've seen since 2010. While we cannot predict when the mean reversion on the PE discount might happen, inflection points have historically coincided with after data point extremes. And when that happens, I think the S&P 500 equal weight index will benefit by seeing a re-rating on its valuation. So with that, I think that's all the insights I wanted to share today, but just a very quick recap of what I've just shared so far. We've seen how UCITS ETF can actually be more tax efficient for non-US resident investors, especially in the case of how US underlying due to withholding tax savings. Number two, we've also seen how the S&P 500 equal weight index actually gives you the benefits of diversification through broader sector representation as well as a reduction in concentration risk. And thirdly, we have also seen how the equal weight index has historically outperformed that against the standard market cap. And the outperformance tends to happen in period of economic recovery as well as the broad-based market bull run. And last but not least, over in this chart that we saw here, the equal weight index is currently trading at a very meaningful discount, and the mean reversion to this could potentially benefit the equal weight index. And in conclusion, the S&P 500 equal weight index offers a very different take to your usual S&P 500 exposure, but with an equal weighting approach. But what I will highlight is that the equal weight as well as the standard market cap need not be exclusive. In fact, these two exposures can be used in conjunction in your portfolio construction to kind of manage and navigate your US exposure under different market conditions. And I believe this is something that Syfe is doing very well with their core portfolios. With that, I would like to conclude my segment and pass the time back to Ritesh and Raman. Thank you.
Thanks, Jonathan, and thanks, Andrew, for covering both the aspects of the new elements that we have introduced into our portfolios. And really, I think the key message from us is, look, we are trying to make sure that the portfolio aligns from a longer term perspective to the broad markets, but at the same time, we are incorporating core value drivers to your long-term outperformance, right? So with these elements of the value stocks, the quality stocks, the MOAT aspects that Andrew mentioned, as well as the whole size aspect, right? Like things that Jonathan was talking about. These are all elements, and given the backdrop of the interest rate environment and the broader macro landscape, given the concentration risks that we are seeing, etc., and all as well, it is actually very, very important that you as investors also think of these aspects while constructing your equity and broad-based growth exposures. And that kind of like brings me to the point which if you go on to the next slide, why you should choose a Syfe portfolio strategy versus DIY investing yourself, right? Like you can obviously buy these ETFs directly, right? Like but how do you know which ETFs? And we've talked about MOAT and XDW, but there are tons and tons of these portfolio, like different options available in the market. How do you choose the right ETFs? How do you, think about whether they are outperforming, underperforming? Are they tracking the index, the way they should? Are they UCITS and tax efficient and all of those optimizations incorporated? Does the tax optimization get eroded away because there is, higher management fee? We have taken all of those into consideration in terms of, constructing our portfolios. And that's why if you look between a core portfolio strategy and a DIY strategy, obviously ours is a much more systematic way versus like, you as an individual investor will highly depend on your own individual skill set and experience in terms of, defining your investment strategy. Our strategy is built for that long-term, consistent, risk-adjusted return. There are a lot of like benefits that you just get as part of our platform offering, like dividends get automatically reinvested. We will rebalance your portfolios on an annual, biannual basis. The fees are all inclusive. You don't pay for brokerage, right? Like, we take care of all your brokerage fees, but, if you're investing into individual stocks, you pay all of that separately. And again, like, we have risk management incorporated. The effort that is required from your side is very, very minimal. You can really automate your investment. I think that's the key aspect, right? Like, all of us are busy. You leave this to the experts. We focus on asset allocation. We focus on optimizing your portfolio to drive long-term returns. And you make your investment on an autopilot by DCAing or dollar cost averaging into these portfolios. So with that, I think quickly I'll share a quick promo code as well for new investors who want to try out our different portfolios, especially the equity and core portfolios in general. And we will move on to the Q&A section because I'm conscious of time. We are 8:06, so maybe we'll take 15 minutes of Q&A across different topics. So let's move on to that. Yes, so if you have not yet joined, please join the Q&A as well, scanning this QR code. And okay, I think the first question, let's take that up, right? Like, I think it is more directed towards us, like why has Syfe decided to do such a major rebalance at this time? So look, I think there is two key aspects. One is like we are doing this rebalance mostly, first of all, to align to the broader market, right? We have seen that if you have significant elements in your portfolio that can lead to deviations in your performance and all, that is something that we want to avoid as we move forward. So the first and foremost reason why we have embarked upon this rebalance is to make it more robust. And even though our portfolios have outperformed over a historical period, but this is to make it even more robust as we move forward, making sure that we are aligned to the broader markets, and we really focus on the key drivers of outperformance, which basically comes back to these rule-based smart beta factor overlays, whether it is the value, quality, size aspects that we have introduced. These are things that we had already some exposure, but I think we have used this opportunity to also make sure that we are optimizing your portfolio from a tax savings perspective. Also, this is number two, a key juncture that we are on. We are moving from a rate hiking cycle to a rate cut cycle. We are seeing very high concentration risks in the market, and these are things that we as investors need to take note when it comes to broader long-term strategic asset allocations. So this is looks major from a perspective of the changes that we are doing. But from an investor perspective, I think it will give you much more confidence about our investment process and the fact that we are doing it, taking into account market factors, the long-term commitment that we have in terms of aligning our portfolios to broad benchmarks, but also driving that outperformance in a more systematic long-term basis as well. All right, let's go on. I think I'll take the other one later. Do you see value ETFs outperforming growth ETFs in the coming few months? I think maybe, Andrew, I'll, move it more to your side. I think we've seen obviously the growth stocks, dominating market performance, and maybe Jonathan, you can add some perspectives as well. You covered, that whole aspect of mega cap dominance. But I think maybe from Andrew perspective, from a quality and MOAT perspective, and then Jonathan from a concentration risk perspective.
Yes, absolutely. So I'll first just preface by saying that who knows what'll happen over the next couple months. That's obviously a very short time period, but we would say over the next few years, we absolutely see more attractive investment opportunities in the value space than we do in the growth space. And during my remarks, I showed the Morningstar style box and where the Morningstar Wide Mode Focus Index operates typically. And I mentioned it almost always is in the large blend style box. Sometimes it leans more towards growth, sometimes it leans more towards value. Currently, it has about as large a bias towards value as we've ever seen in the 17.5 years that it's existed. And what that means is that we see far more attractive opportunities in the value space relative to the growth space. So certainly, we would argue, based on our stock by stock fundamental research, that the value factor is far more attractively priced right now than the growth factor, and that's reflected in the positioning of the Morningstar Wide Mode Focus Index towards a bit of a value bias relative to growth.
I'll just add at least from my side, from the perspective of the S&P 500. Sorry, go ahead.
No, I was just saying that I think your voice was not audible previously, but go ahead.
Right. Okay, I just wanted to share some insights, at least from the S&P 500 Equal Weight Index. I mean, when we look at the factor of the S&P 500 Equal Weight, it's really much more on the what we call value factor as compared to your standard S&P 500 index, which is more on what we call a momentum factor. And historically, like what I showed in the charts, typically the S&P 500 Equal Weight Index tends to outperform in periods of market recovery on the back of interest rate cuts. And that tends to favor a little bit more in what we call the smaller size cap stocks, which is why the size factor as well as the value factor tends to benefit on that front. So coming back to this question, do you see value ETFs outperforming growth ETFs? I won't go into specific on product, but based on the index factor perspective, I think we could potentially see the equal weight actually outperforming that against the standard index itself. Yeah.
Awesome. Thank you, Jonathan and Andrew. Let's go back. I think like the questions are a lot. Maybe Aman, if you can shed a little bit of light in terms of, exposures, like, before, after, how that has changed post this rebalance. Like I think this question around country breakdown, but you can take it more like, broadly as well, if you can.
Absolutely. I guess I'll start with when we think about exposures and we're thinking about our benchmarks for each of the core portfolios. Now, where we're tilting our portfolios to various factors, then of course that is going to go away from the benchmark. But something we need to be mindful of, whether it's countries, sectors, durations, credit quality, is we don't want to be taking sizable tilts. Every tilt or allocation we take is done in a thoughtful and measured way. So in terms of the new country breakdown, this is still a majority US portfolio from an equity perspective. This is around 70% or so, which is in line with our benchmarks broadly. The further details can actually be found on our website with a full breakdown. But I can tell you that the US is highest. Then we have China at around 10%, and that's around due to price drifts and adjustments in our EM exposures as part of this rebalance. I think I'll touch on sectors as well whilst we're here, and I think we've noted and others have in the questions as well. From a sector exposure perspective, we don't want to be taking significant sector tilts where that could potentially lead to significant performance deviations over the short term. Now, whilst the objective of these portfolios is around risk-adjusted returns over the long term, we're mindful and we're conscious that clients will be watching these portfolios, and how they perceive different deviations in performance, whether that's positive or negative, is important for us to take into account here. And so from a sector perspective, we've actually reduced the exposures away from the benchmarks there. In terms of sharing the full details, I'd encourage folks to take a look at our website. Each portfolio has a full breakdown of its country and sector compositions.
Great. Let's move on to the next one. I think you've already addressed now the sector, allocation changes. So the rationale of removing all the sector-specific aspects. So, that you've already covered, as well as, this other question of the exposures. Maybe another one, like, Aman, from your standpoint, like, what is our investment process in terms of selection of ETFs, right? How do we decide this allocation? What is, aspects that we consider, like, for example, why did we pick, the equal weight from XTW? There are many equal weight options available in the market. Similarly, why did we pick specifically Morningstar, as the wide moat and the VanEck kind of like, ETF on it? There are plenty of, value and quality ETFs out there in the market as well.
Yeah, I'm glad they asked that. It's something that, of course, we spend a significant amount of time each and every day thinking about. So to cover a few of the key things we're looking at, first, we're looking at the different exposures that we're trying to express with the ETFs that we're selecting. And that helps us filter a huge ETF list down to the key relevant ones, whether that's equal weight S&P, or whether that's a particular factor that we're trying to express, or geography. Now, when it comes to going through and screening those ETFs, there's a number of different things we look at. We can look at the fund house's methodology, how rigorous they are, how consistent and disciplined they are with their approach. We can look at their performance, their track record. A couple of other more mechanical things, though, actually, that we have to consider when it comes to the ETFs is also their liquidity. How easy are they for us to trade into and out of on behalf of our clients? And what is the net cost of not only that, but the ongoing costs from the ETF? So these are all things that we take into account. Now, I think when we we look at, for example, UCITS. That's an area where we take a very specific decision. Do we transition or switch this particular ETF to UCITS? That there, essentially, we're comparing the dividend withholding tax savings and the improvements in performance that will generate against the bid and ask spreads and the implicit cost of us implementing that switch. And that's why we will only make those UCITS switches where it's optimal for us to do that on behalf of our clients. And that's another area that clients don't need to worry about. You have the peace of mind that we are making the appropriate UCITS switches for you. There's a reason that we've increased to 40%, not somewhere closer to 100% or lower than 40%. We've found that this was, at this occasion, these were the switches that made sense for our end clients.
And that's a great point, Aman, because I think on the surface, everyone thinks that as a non-US resident, the UCITS ETFs are the best. I think the reality is we obviously need to go into the details of the tax savings versus the kind of like the implicit cost that we've talked about. And that's why, we are, glad that we've been able to, improve these UCITS allocations, because the liquidity has greatly improved in the Irish domiciled ETF space, and especially with leading houses such as DWS, making a conscious effort in that space, we have been able to transition into more UCITS oriented strategies for our end clients and all as well. But again, some of our other things like MOAT right now, we're still in the US domicile. If you talk about your NASDAQ 100, we are still using the US domicile ETFs there, because it actually just makes more sense from an overall cost benefit analysis standpoint. So let's go back to the next question. I can take quickly. I think there was a question around China stocks. So look, I think fundamentally we do have a little bit of an extra exposure onto the EM markets in our portfolio strategy. And, that's mainly because I think some of the EM countries are underrepresented in the broader indices. So we do have around, 9 to 10% exposure to China in our equity portfolio. And that is, again, to address the, fundamental, I think, underrepresentation of the, broader EM markets in these benchmark indices. Now, as part of this change, actually, we have not done any increase in allocation to China. And again, I think the reality is, while China over a longer period does, result in better, returns, over the more shorter, cycles, it can be hugely volatile. And you've seen that over the last, few years, how, regulatory, geopolitics, et cetera, has played a role in terms of, the underperformance of Chinese stocks. And only in the last 1 month or 2 months, we've seen, with the policy fiscal stimulus coming back in, some resurgence in the Chinese stock market. But again, if you look at today morning, there was a little bit of disappointment. We're seeing the Chinese stocks again going down. So there is a lot of volatility associated. It's not for everyone. We want to have that, EM exposure, but not to the extent that it derails your long-term, kind of performance and all. So we have just adjusted, the EM allocations to address the price drifts, meaning that overall, the allocation to China and broader EM is more or less like, consistent past this rebalance cycle. If you go back, maybe Aman, if you want to take and things around again how our portfolio constructions and all take place. The VWRA is a strategy that a lot of investors use for global portfolio and growth investing. And maybe again, if Andrew and Jonathan can chime in, because you can obviously buy a globally diversified growth exposure, but by just buying this VWRA ETF. So, why use Syfe's, methodology and portfolio in the first place?
Yes, I can certainly kick us off there. And I think you covered a lot of this in your slides around core portfolios versus DIY investing. Now, first, I'd point out we're outperforming VWRA in performance. And now, when we talk about globally diversified ETFs, I mean, concentration risk is still an issue when it comes to picking and selecting one ETF that you're going to be investing in. having the flexibility and the oversight to ensure that your exposures and your long-term returns are being managed, I think there's still a decent value proposition for that. If we think about the top 10 holdings and just how diversified, in a true sense, a globally diversified portfolio is, I'd say there's still a significant amount of concentration risk there as well.
Andrew and Jonathan, what do you guys think, like, when it comes to, obviously, you can take a parallel, it doesn't need to be via VWRA, but obviously like index investing in general, you can already, get the market performance. And, I think obviously there is an fully active sort of way of doing it versus there is a rule-based, this active, overlays that we have incorporated into our strategy through MOAT, through, XDW, et cetera, and all, basically trying to capture these fundamental factors that drive these long-term, outperformances. So if you can allude a bit more on that front.
Sure, I'll be happy to start. And I'd start by reiterating Aman's comments about concentration, right? So with the S&P 500 having somewhere around 1/3 of its weight across just 7 stocks, I would argue that the broad-based index, the S&P 500, is actually far riskier than investors typically understand. And so having a more broad-based, better diversified index solution can be very valuable. For the Morningstar Wide Moat Focus Index, just as an example, less than 4% of the weighting of our index is spread across Magnificent 7 stocks, right? And we've consistently been underweight the Magnificent 7, or a few years back when we used FANG or FANG Plus as the acronyms. Despite being underweight these baskets of high-performing big tech companies, we've still managed to deliver a very favorable performance track record relative to the S&P 500. The other thing I would just mention is that, this is specific to the Wide Moat Focus Index, it's a very nice mix of active and passive. And what I mean by that is it's active in the sense that we have talented equity analysts, providing very comprehensive fundamental research on individual companies, and all of that goes into stock selection, right? We talked about the economic moat rating being a forward-looking assessment of competitive advantage. When we talked about valuation, of course, being subjective as well. We're forecasting cash flows into the future for companies. So that's very active. But then the index wrapper by which we deliver that research is totally passive. It's a rules-based index construction methodology with a quarterly reconstitution. So we would argue it takes the best of active research, combines it with the benefits of a passive implementation. And I think that's really helped eliminate a lot of behavioral biases that come along with portfolio management on the active side. But it's also allowed us to be more disciplined about valuation and not just have that super high concentration with hefty exposure to all the biggest companies that have maybe performed well in recent history, but who knows, may not perform as well in the near future.
Thanks, Andrew. Jonathan?
I'll just add from my perspective. Yeah, I'll just add from my perspective, at least say, for example, an MSCI World Index perspective. I mean, a lot of people don't really know it, but if you dig a little bit deeper, actually the US accounts for about 70% of the portfolio over there, and there's a lot of concentration risk on some of the large caps. So if you're an investor into something like a broad MSCI World Index, I think you just have to be comfortable with the fact that there may be some concentration risk in the aspect, and so you could potentially see some volatility if some of these mega caps actually do come down. Well, in the past few years, that has actually done well because, we saw how the Magnificent 7 has actually rallied quite strongly over the last 2 years, but that could actually be a double-edged sword, and that when it does come down, it also could move down pretty fast as well. Now, in the index world, I think what I'll mention is there are a lot of building blocks out there, so it's not just MSCI World. You can even break it down into sector plays, factor plays, depending on how you want to look at these indices. And this is where I guess probably Syfe comes in as a value add because, with these managed portfolios, I think the team of Aman and Ritesh do look into these factors and think about how they want to allocate into them to kind of guide your clients in terms of how you want to navigate this exposure. And that could potentially value add and generate, I guess, probably better returns as opposed to something of a broad-based index. That's probably just some of the insights I wanted to add here. Thank you so much.
Thanks, Jonathan. Let's maybe take one more question. And I know there are still a lot of questions that we need to address, and maybe we will address them as part of like, our blog, a summary blog that we will, come back with over the weekend. But I think there was one question around SRS investing. I'm not seeing it here, but like, Aman was pointing me out that, can we invest into these various portfolios using SRS? Good news is we have just introduced SRS investing as well. And that is now available across, our different portfolios, including Equity 100, Income Plus, as well as, the cash side. The constitution of the Equity 100 portfolio on the SRS side is, slightly different because of the eligible, like universe of underlying investment vehicles that are allowed within the SRS kind of like, mandates. So, but the process exactly is the same, right? Like, we are trying to make sure that you're getting the broad-based index exposures, and then we are enhancing it with these, core factor overlays that drive long-term, superior, risk-adjusted performance. So yeah, I mean, like if you've not yet looked at it, please go to our, app, and you are able to basically invest your SRS monies through our, different strategies, including Equity 100. Maybe if we go back, Aman, if you want to address any more question quickly, otherwise, we take our leave, because I'm conscious, like, Andrew, it is pretty early on, and Jonathan as well, it's getting pretty late for you. So if you want to take one more and then wrap it up.
Yeah, I think I'd just pick out there that there's a question around if our core portfolios are currency hedged. And I'm glad this has been asked, because it's something that it's unclear to us how many clients would want this or not. When we talk about currency hedging, particularly from an equity perspective, the common consensus is that the costs involved with hedging that exposure don't outweigh the benefits, and so we don't typically look at providing that for clients. It's something we discussed with some of our key partners, and I'd say the reason I picked this one out as well is if that's something that is of significant interest and value to our end clients, then do let us know that. So far, we haven't seen a need to add that, and we don't think as a default it would make sense for our clients based on the performance drag that the costs would involve. But we're more than happy to hear if that would be of interest and value to our clients.
Just a quick one on that. I think, like, while currency hedging maybe gives you that comfort that it will lead to better performance. Actually, again, the vote is split. There is costs to these hedging aspects and all, especially for growth-oriented portfolios, which is what these core portfolios are meant to deliver. The hedging costs can be like I mean, like the actual returns of these portfolios far dominate, because you're trying to reinvest and you're growing and compounding your returns. So overall, even with the if the US dollar continues kind of depreciating against SGD and all, the actual growth of the portfolio is what matters more to you, versus like if you look at our income portfolios, for example, we do incorporate currency hedging aspects there, because you're trying to generate current income, and from that current income standpoint, you want to make it very, very consistent, and you don't want like significant deviations in terms of your like the dividend yields that you're generating and all. So I think where required, we do incorporate these hedging aspects and all, but for a growth oriented portfolio, we don't believe the costs of hedging justify doing that, and you're much better off taking the direct exposure to the US market and riding it out, and focusing on the long-term growth there. Awesome. I think with that, I'd like to close. Thank you, Andrew and Jonathan, for joining us today. Very, very happy with what we have been able to achieve with our core portfolios, and very excited with what the future unfolds for us as well. We would keep our investors in tune as we move along towards the last quarter. And again, like there's a key inflection point when it comes to the interest rate environment, but also there are some big short-term events that can lead to high volatility. So keep looking at your portfolios, your allocations, and do reach out to us if you have any questions. We have a very dedicated advisory team, And of course, both me and Aman will be happy to, look at any of your questions more specific to our investment process as well. So with that, maybe Aman, if you have a closing, thought as well, we'll, take a leave from then.
Yeah, just to echo your comments, do reach out to the advisory team or us with any kind of thoughts or suggestions or anything you'd like clarified. And thanks again for joining. It was a pleasure to walk you through this material.
Thanks, everyone. Have a good evening. Thanks, Andrew. Thanks, Jonathan.
Thank you. Take care.